Starbucks just reported a double beat on earnings and profit. They're up 3.5% immediately after hours. Meta is reporting tomorrow. Guys, wild week in the market so far. Yesterday, the NASDAQ fell hard, over 3.5%, while the Dow was actually up. The NASDAQ made up some of that today, rebounding about 2% after NVIDIA yesterday fell 16 or 17%. Guys, here's what Starbucks reported. $9.4 billion in revenue versus $9.32 billion expected. 69 cents in profit versus 67 cents expected. Guys, I own Starbucks. I've been buying Starbucks since, 70-something? Yeah, mid-70s. I don't think the story's over. I don't think Starbucks is dead. The market's been up a lot lately. That's what's driven up this price. Don't ever buy anything because somebody on the internet or even Warren Buffett owns it. Buy it because you've learned a process. We're here to teach a principle-driven investing process. We're investors, not speculators. Every investment's a present value of all future cash flow. If we don't understand it, we don't invest in it. And we don't look at market prices in the short run to determine if we're right or wrong. Guys, this is the short run. It's up in the last year, only 8%. But in the last 6 months, 35%. This does not tell me I'm right. What'll tell me I'm right is 10, 15 years from now. As long as they keep on this path, keep their process going, this is a company that can generate a lot of profit and grow its value. And we'll break into that very shortly. Let's go into their quarterly report to see some things that might be interesting for them. Now, guys, let's look at this first. Number of stores by location. North America, Canada, United States. It's about even. Look at that, 6,500 stores to 6,777 in the US over almost 3 years. That's not much growth. Why? It's a very mature market. 469 in Canada to 486. Also not a lot of growth. Very mature market. These are all the countries they have. All the countries they have. All the way down here. Look at all of this. They're in all of these countries. Incredible. China's seen a lot of growth. A lot of growth overall, guys. Starbucks is still a growing company. They have 9,800 stores internationally. They've got licensed versus non-licensed, total stores of 40,200 between licensed and co-operated versus 34,000 back at the first quarter of 22. So still a growth story in essence here. Guys, they just reported like $96 million compensation to their CEO. CEO kind of got a lot of flack because he flies from California to Seattle like, I don't know, is it every day or whatever it is in the private jet to operate this business? I get it. And that's a lot of money to give somebody in his first, 3 to 6 months in the job. But hey, hopefully it works out for Starbucks. Let's dive in a little bit deeper into their quarterly numbers. So guys, their Q1 net revenues of $9.4 billion, flat to the prior year with a clear path forward. There's been some resistance on this and a lot of talk about it. I've even heard some people say they're done with Starbucks, but we'll see if that actually happens. Now, here's an issue I don't like. Global comparable store sales declined 4%. Same with North America and US, driven by a 6% decline in comparable transactions, but partially offset by a 3% increase in average ticket, probably inflation related. That's kind of a problem for me. Same with international stores, declined 4%. They opened 377 new stores in Q1, ending the period with 40,576 stores. 53% are company operated, 47% are licensed. Operating margin down 390 basis points. That's 3.9% to 11.9%, primarily driven by deleverage and investments in support of back to Starbucks. Guys, the numbers aren't great. And we talk about this a lot. What I'd like to do is I own Starbucks at a much lower price than this. I'm not adding Starbucks at this price. It might make sense to you, it might not. Don't go based on what I said. But I look at Starbucks saying, do I see a world 15, 20, 30 years from now where Starbucks does not exist? I don't. And that's what I like to invest in, companies that I see for the long run. But I don't stop there because the fifth pillar of our principle-driven investing that I didn't mention yet was if the story is good, it can become a bad investment if you pay the wrong price. If the story is not so great, but you pay the right price, it can be a great investment. Let's go to extreme. Let's say today you could buy Starbucks stock for $1. Would you do it? Let's say you could buy the entire company for $1. Would you do it? Of course you would. It generates 70 cents per share. You get your money back in no time. Okay, go to the other extreme. What if it was $10 trillion? Would you buy it? No. So we have these two extremes. Somewhere in the middle is a great price for the company. That's all we're trying to do as investors. But in the meantime, here's what the stock's going to do. And in the meantime, all of these things are going to happen. There's going to be a lot of bad news. The bad news is what drives the stock price down. But you know what's interesting about Starbucks? All-time high wasn't that far from where we are today, $126 a share. But it was almost 4 years ago. It was 3.5 years ago. That's what's interesting. Look at this return on capital, 45%. This company makes a crap load of money on the money that's invested in the business. They pay a big dividend that eats up pretty much all of their cash flow. Kind of bothers me. Kind of bothers me a lot. Guys, if they're crappy, if the stock price is down and crappy, buy shares back. I'm personally against dividends when it comes to companies like Starbucks. Funny part is, current price of free cash flow is 35. Current PE is 30. Again, I was not buying it at 100, but let me show you guys why it's important to understand these things. Let's go to our analyst estimates, because remember, every investment is the present value of all future cash flow. Look what analysts have for the profitability of Starbucks for the next 5 years. $3.20 a share, going to $7.42 a share. Over double. Revenue growth, not much. $38 billion to $56 billion. Actually, it's pretty decent. It's high single digits. Now, it's not going to be a smooth ride, but I do think Starbucks will grow its revenue, especially as we have inflation. People make more money. They can charge more for their products. But guys, what we have to do here is we have to marry the story with the numbers, put them together. A story by itself without any numbers is a fairy tale. The numbers without any story is just an Excel sheet. That's what Professor Oswath says. And by the way, I was in a flight this weekend coming back from Dallas, and there was a guy sitting in front of me, and it looked exactly like him, but it wasn't him. So that'd been funny if it wasn't. Anyhow, let me pull up Starbucks in our history. By the way, Starbucks is now up over 4%. Okay, I did a 10-year analysis. Profit margin, I did 10.5, 12, and 13.5, and I did 10, 12, and 14 for free cash flow. Now, guys, the last 5 years has been 10%, but they did 12% over the last 10 years. So am I getting a little aggressive here? Let's do this. Let's change this to 10, 11, and 12% revenue growth. Sorry, profit margin. And as for free cash flow, I'm going to go 9, 10, and 11%. I might be a little conservative here, but I'm okay with that. Now, for PE and price of free cash flow, it's a great brand. It's a great moat. It's got really high returns on invested capital. These are all the things we need for a premium. The question is, how much of a premium? I put 20, 22.5, and 25. If you think that's too high, I don't blame you. If you think it's too low, I don't blame you. This is what makes investing hard. This is the art of investing. We don't know the right multiple put here, but I did put my 9% desired return. 9 or 10% is the market return, so it basically gives me what I think the company is worth. But you need margin of safety. You need to make this 9% higher. For those of you who have our software, when you put this 9% higher, it'll make it so that you can make those mistakes that we're going to make because the future is unknown. So do that. I hit the analyze button. The stock's currently at 105. I have a low price of about 60, high price of 110 to 120, middle price of 80 to 90. So as you can tell, that's why I was buying it sub 85. So let's break down Meta now, because it's a major trending company right now. Guys, Meta is one of my biggest mistakes ever. I was buying it as it fell all the way to 88. In fact, I bought it at $88, but sold it at $195 because it ran up too fast, even though I thought it was a screaming deal. And now look at it. It's at $675. Huge, huge blunder on my part. Learn your lesson from me. It was me deviating from what I understood to be true. That this is a great company that's generating a lot of profit, and it has crushed it since then. It's up 211% in the last 5 years, growing return on invested capital 15%. Guys, even at this high number, 33 times free cash flow, which means at 100, it was selling for essentially 5 or 6 times today's free cash flow. That's how incredible the business is. $52 billion in free cash flow, and this is after they're spending $10 or $12 billion a year on their metaverse, which is not working right now. And they also announced, I think they're going to spend an extra $60 billion on the Meta. Guys, this company's printing money. It has WhatsApp. It has Instagram. It has Facebook. It has half the world on their platform every single month. And how much of the world still hasn't even been on the internet yet? We still have tons of the world that needs to get out there. And guys, if you live in the US, you probably don't even know what WhatsApp is. I'm sure you do. But if you live outside the US borders, everyone knows what WhatsApp is. They don't even iMessage. I once dated a girl from Mexico, and she even said to me, we don't even use iMessage. Because I once texted her an iMessage, and she never responded. I said, hey, what's the deal? She goes, yeah, we don't use iMessage. Literally, all it was WhatsApp. What an incredible, incredible thing that Facebook has there. And the best part is, they're only charging a fraction in ad costs internationally in many markets that they charge here. They're charging like $40 or $41 per person in revenue here in the US, North America. Internationally, there's some markets, they're still at $4, $5, $6 per person in revenue. Imagine when the rest of the world becomes wealthier and wealthier, what's going to happen with that? And remember when the fear was Apple shutting down, it's going to lock up its privacy. Nobody's going to be able to advertise anymore. You know what Meta said to that? Yeah, go F yourself. And they just look at this, they just crushed it. And I think I saw recently, even Zuckerberg saying that if it wasn't for those rules, Facebook would be making tens of billions of dollars more per year in revenue. So they're still able to crush it even with that. Look at this revenue growth. Incredible. They do in 1 month now what they did in 2014 in total revenue. Absolutely incredible business. And another big company right now being talked about, Alibaba, another company that I own. Again, do not buy because anybody else on the internet or the world has it. But it was up 6.76% today. Guys, I want to tell you something. If you'd asked me to guess what Alibaba's price was today, I would have said $80. I don't even pay attention. I don't pay attention at all to where my stock prices are. In fact, I do that so that I don't allow myself to get emotional about ups and downs in the market. I don't want to see myself making a lot of money because I don't want to get cocky. I don't want to see myself losing money because I don't want to make bad decisions. But Baba's getting a lot of attention because they were upgraded with a higher price target, blah, 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 because of AI. AI is the reason for everything. At the end of the day, what I think about Alibaba is what I'm going to show you here about the stock analyzer tool. My entire thesis on Alibaba. Are there concerns because of China? Absolutely. Are there concerns about all those things? Absolutely. Goes back to my question. Do we think China is going to be a bigger and freer economy 10, 20, 30 years from now? If your answer is no, this is not the company for you. If your answer is yes, you might want to take a look at it. Because here are my assumptions about Baba going forward. 3, 6, and 9% revenue growth, which is not a lot for a company that's in one of the fastest growing economies in the world. China has a recession when they're growing at 4 or 5% a year. To us, that's a booming economy. We don't see 4 or 5% real growth normally. So 3, 6, and 9%. Profit margin, 12, 15, and 18. And that 15 is still below their 10-year average. Free cash flow, 15, 18, 21. That 18 is below their 10-year average. PE, I put 16, 18, and 20. And a 9% return. The stock's currently at $96. Hit the analyze button. Boom. I have a low price of 100 to 130, high price of 280 to 234, middle price of 175 to 212. I think the juice is worth the squeeze for me. And if it is for you, great, but do your own research. More importantly, join our community. If you join our community, you get all these tools, you get everything it has to offer, and the chats. There's even a specific chat about tech stocks, about China and Alibaba. Join it. It's $7 per day. Go to everythingmoney.com/sign up. Or click the link below. See you tomorrow for Meta earnings and the Fed rate decision. Thank you for your time.